It's my pleasure, truly, because I have the pleasure of having two women economists. I don't remember a panel since morning where we had two women. So thank you, both of you, for joining us, taking time out to be with us this evening. Indranil, of course, to you as well. Priyanka and Gaurav said that they use the metaphor of storm and a ship. India is like a ship which is trying to sail through it. And the favorite word of American president, as he himself said, is the word tariff. But that unfortunately has become a terror word for the rest of the world. So the first thing I want the panel to do is to help us unpack what this tariff impact is going to be, because we've heard a lot about tariff, reciprocal tariff as well. How is it going to play out? What are the rates at which it's going to play out for different products? How easy is it even to put something like this together? So, Shubhda, let me start with you. What is President Trump really saying when he says it's going to be a reciprocal tariff, especially for India and other countries, starting April 2? What should we expect?
Well, I think to start on a slightly positive note, that when you look at the storm across the globe with Trump unleashing the tariff war, how is India placed? And I would say on a relative scale, India is better placed on 2 or 3 counts. One, of course, that our export to GDP ratio, our dependence on exports for growth is relatively lower. However, in an integrated world, it's not that there's not going to be any impact. There will be impact, but not as much, say, as economies that are facing a direct hit in accordance with what Trump has already done with Canada, Mexico, and China to begin with. Come April, and he said that there would be reciprocity in terms of whatever India charges, we will charge India and other nations as well. On that count, yes, India does have high tariff walls. We do see weighted average, globally. If you look at India on the map, India stands pretty high in terms of tariff-led barriers to trade. But if you combine tariff and non-tariff barriers, probably US would slightly be superseding India in terms of non-tariff barriers if I combine to tariff. Having said, yes, there is bound to be reaction because India's trade surplus has gone from 6 billion to say about 34-35 billion with the US a year gone by, that is in 2024. So we can anticipate reciprocal tariff measures, which will be on anvil soon enough, I would think. However, there's work in progress. We are working on a trade deal with the United States a few months away. Our Commerce Minister is already there in the US to undertake negotiations. How resilient we will be? I think there are a few sectors we can't really play the economy-wide impact, but there will be few sectors where India will have to, lower the tariffs. On energy side, India has already begun to do on some of the consumer goods. If you look at the profile, India has had more protective tariffs vis-a-vis US, more in the space of intermediate goods and consumer goods. Some part of it was dealt with, quite smartly in the budget on automobiles, particularly Harley-Davidson, if I were to specify. But having said, it's a work in progress. I think Newton's third law of motion is very much at play here, that action and reaction is going to be equal and opposite. I don't think everything is going to settle at one go. Over the next 2 quarters, we will see US versus rest of the globe actually fighting it out in direct tariff wars. India will not be in a position to threaten with the tariff war, but would have a more conciliatory kind of, a more dialogue-oriented approach towards dealing with this addressing of a larger trade surplus that India carries with US.
But, Rajni, if you look at the fallout of the tariff war that's going to play out, there is no doubt that it's going to be twofold. One, it's going to have an impact on the overall economic growth of the world. In fact, the IMF said it's the single biggest threat to growth, tariffs, right? And the number 2, it's going to jack up inflation pretty much everywhere. How is India placed on those 2, counts?
So I completely... So I completely agree with Shubhada that the impact relatively of the tariff from US would be relatively low on India, the direct impact. Because if we look at India's export to US, it contributes around 2% to India's GDP. And if we look at if there is reciprocal tariff, the additional tariff that can come because of that would be around 8 to 9%. And on top of that, when we have done our rough calculation, we have taken into account that rupee will also, RBI will, take recourse to let the rupee weaken a little more. So after factoring that into account, on a direct basis, roughly you can say the impact would be around 0.1% of GDP. But that's not all. What you said, that's important. Because this is the direct impact. But overall, if global trade slows down, which is going to happen, and global growth slows down, that will definitely have a more severe impact on India. And also the fact that, right now our manufacturing sector is dealing with this dumping of goods from China because of excess capacity there. And then we could see even more of that happening.
Exactly.
So that's something which, the economy will have to deal with. But, the other aspect is also that there are some opportunities in this whole trade war that is going to play out. And in this situation, when we can't do away with what US is going to do, the best thing which is in our control is to see how can we tap into those opportunities. And one thing is that, some of the economies like, say, Canada, Mexico, China, they are going to get relatively more impacted by this. So India should see as to how they can take up some of those opportunities. Also in terms of, again, this whole China plus one thinking is still going on. So that opportunity is also there. So what can be done to attract more FDI in terms of, in this last budget as well as in eco-survey, there was a lot of talk about improving the ease of doing business, reducing the regulations. So if we quickly move in that direction, then there are some opportunities which we can tap into. But yes, otherwise, if you see, the direct impact may not be much, but indirect impact can be huge, not just in terms of global slowdown, but also in terms of, many other linkages like investment, capital flows. So all that will impact us.
Exactly. So Indranil, that brings me to my next point, which is if you look at the growth over the last several years, largely driven by government's generous capex expenditure, strong, private consumption. If there is uncertainty, private consumption for sure, people will be more cautious. People will start saving more and then not spending. That's number one. And if let's say the slowdown hits India as well, even if it's just say 0.1%, but in terms of sentiment and government's actual revenue collection, we might see a drop in revenue collection. So how well placed are we to cope with these two shocks? Because these are two really engines which have really driven the economy so far. So what's your take on that?
Well, my limited point on revenue collection is that I'm not really worried too much. In the sense that a significant buffer to the whole revenue generation model has been the RBI dividends. And the RBI dividends, given the fact that we are and as Rajni said, we are depreciating the currency and we calculate that on the basis of an historical cost, is likely to give bumper profits, and therefore that will be passed on to the government. So revenue generation model I'm not too worried about at this point in time. What I'm really worried about, and certain parts, of course, my two other friends here alluded to, is that the government possibly is reaching a limit in terms of how much of capex they can do. Now, the government obviously has done the low-hanging fruits, which is basically the railways and the roadways. Now, you can't continue to build roads. You can't continue to sort of provide a push to agriculture because your land mass, the railways, because your land mass is what it is. Now, the next step is therefore you look at investments more in softer areas like, say, education, healthcare, where I don't think the government as a whole has been doing a lot. And in the whole sort of journey towards Viksit Bharat, I think these are the elements that needs to be plugged in a very significant way.
Right.
The second aspect which worries me a little bit is the inflationary perspective of the tariffs rather than the growth perspectives of the tariff, because as Shubhda also rightly pointed out, our share of GDP, exports in the GDP is just about 11.5%. We are still more inward growth-oriented economy. And if the whole supply chain across the world gets fractured, and that in turn leads to higher cost for manufacturing and therefore higher inflation, we have had lots of trouble getting our inflation down. Right. So that indirectly will have its impact in terms of lower consumption behavior, which necessarily means that even as the government is on a relative basis moving out on the from the capex side, the private capex is unlikely to actually move in strongly in this atmosphere. So that, I think, is a bigger worry for me rather than the real tariff structure that is playing out.
Right. In fact, the Prime Minister even yesterday made a point about how private sector needs to step in. So why do we see so much reluctance? Is it because is there an overcapacity, or what is the reason why private sector is not willing to make fresh investment?
Well, I think, it depends a lot on the visibility of demand. At the end of the day, why will I set up an extended manufacturing plant is when I am 100% confident that there is a demand which is going to be robust. Now, unfortunately, post-COVID, we are living in a very disrupted world, where first there were COVID-led disruptions to demand. Then you've had back-to-back wars. So all of these do have an impact on the confidence of a visibility of demand going forward. Otherwise, all the enablers were in place. You had the competitive corporate tax rates. You had cleaner balance sheets, both on the banking sector and the corporate sector side. Interest rates were more range-bound. They can get lower. But despite these enablers being in place, why have the private sector participants remained in the wings, in the side wings? So one is, of course, the visibility of demand. And two, I'm not 100% sure that, when we look at the private capex appetite, we naturally compare it to our previous capex cycle. Now, that capex cycle was in a different environment where credit flows were very easy. There was not a protectionism that was going through the world, as a philosophy of growth, that everyone needs to look at more inbound and not cater to the global demand. So protectionism has come into vogue.
But Shubhda, we are also looking at investment in the context of the manufacturing push which the government is laying.
Yes. So coming to that, I would think that 2 or 3 things that we need to look at is this private capex cycle is not going to be as irrationally robust as it were earlier in the 2012, 2013 era. And this, we say it because we did a recent project whereby we were assessing the private sector capex appetite. So few things which came to rather glaringly obvious, both from the promoter side and the financier side, was let's accept that there will be a more sober capex cycle. 2, I think somewhere along the lines, we miss out on measuring the capex cycle which is emanating from emerging sectors, which typically is not getting funded through the traditional sources of financing, but are getting incrementally getting financed through alternate finance channels like AIFs and so on. So, not that private capex cycle is dead and gone, or it is completely, extremely tepid. It is there, but yes, as Prime Minister yesterday mentioned, that where are the animal spirits, that this is the seize the opportunity, carpe diem kind of a moment for us, that where rest of the world is grappling with direct heat from US, India still has a China plus one, as Rajni mentioned, and as Indranil said, that, there is a capex, latent capex appetite still that we can look into, just looking at the domestic demand of external demand may not provide those many levers for growth, but our domestic demand should. And where consumption demand, rural economy was doing good in the recent past, urban economies what took the back seat in the consumption recovery story. I think that is where we need to pay all our attention to how to set forces and unleash the forces for reinvigorating the domestic consumption demand together.
So, Rajni, one of the key things would be the RBI's ability to cut rates to stimulate consumption further. And the government is also committed to a very strong fiscal deficit target, 4%, as the finance minister, approaching 4%. If we were to wade into a lot of uncertainty and there is a general increase in inflation, obviously the RBI's, the maneuvering room is going to be limited. So what is your expectation in terms of, let's say, a rate cut, or how are we going to deal with inflation?
So I am not overly worried about inflation at this point in time. I agree with the point that Indranil made that there are inflationary concerns because of tariff. But the comforting factor at this point in time is, for India, inflation was mainly coming from food. It was mainly food inflation, and that too specifically vegetable price inflation. In fact, for whole of last year, if you just remove vegetable price inflation,
onions,
CPI inflation minus vegetable was less than 4%. So, and now what has started happening is vegetable price inflation has started moderating, food price inflation has started moderating. Overall, if you see global commodity prices, with what is happening on the demand front, the chances of commodity prices going up is limited, unless there is another supply shock, which we can't rule out. But at least from the demand side, that concern is not there. So we don't see crude oil prices or base metal prices flaring up very sharply. So in that situation, I'm not too concerned about inflation. So if inflation continues to moderate, as is our expectation, we are expecting one more rate cut by RBI for sure in the April meeting. And I feel there are chances of another 25 basis point rate cut. And that would depend on what course Fed takes. Because RBI, apart from their focus will now be on growth, but they also have to take into account what happens to rupee, what happens to interest rate differential, and what happens to capital inflows. So to that extent, it becomes important as to what US Fed does.
Right.
And I feel that there are chances that US Fed will go ahead and maybe another 25 to 50 basis point rate cut in 2025, because the growth indicators in US are going to slow down. With whatever has been happening, there are already indications that growth is showing signs of weakness. And if that's the case and US Fed goes ahead and cuts, RBI will not hesitate to cut another 25, so total of 50 basis point rate cut. So that's what my expectation is on interest.
But what if, let's say, the tariffs translate into higher consumer prices at the store shelves, right, from avocado to timber to, car parts? If the prices start going up, do you think the Fed will have the courage to...
So like I said, it depends if it's going to be so inflationary, the tariff there are two ways in which tariff will have inflationary impact. One would be by just, prices going up because of higher tariff. And the second would be what happens to rupee, because rupee has been weakening, and that will also have an inflationary impact. If it turns out to be very inflationary, which I am right now not factoring in that case, yes, but I am pretty confident that another 25 basis point rate cut for sure, apart from RBI looking at injecting more liquidity into the system, because there's no point if they keep cutting rates and liquidity is tight.
Right, okay. So Indranil, I think one of the controversies which has been stoked recently is on wage hikes, basically. A lot of comments coming said, there's been no real wage increase if you look at even, IT sector. And I think it was the day before yesterday or yesterday when Dr. Arvind Virmani mentioned that, it's also an issue of skill. If your skill levels are higher, your wages are going to go up. But we are also looking at a potential in era where technology is actually potentially going to accelerate this whole phenomenon of jobless growth. So what's your view on that?
I think that's the most difficult question to answer for India. And to answer you in a slightly different way, I think that's where India is stuck between today and 2047. And I believe that we are in this middle income trap. And peer-rated countries, they have per capita income much, much higher than the $2,700 per capita income that we have. The problem is not the answering of the 6.5% growth versus the 8% growth. The problem is the 8% and the 6.5% growth percolating down in terms of the lower segments of the population? And therefore, I think the whole answer lies in how we can translate the economy. I think this is slightly a contrarian point, but I think the way our economic momentum has happened, it has actually moved from agriculture to services. Whatever development happened in the manufacturing sector, including the PLI, was all capital intensive, while our country is rich in labor. So the momentum has to shift in terms of the labor intensive sectors. A certain portion of that has been addressed in the budget. But I think the critical issue also is how we start looking at self-sufficiency in food and food security because of the challenges that we are facing in terms of capital. So a lot more money needs to go into the agricultural sector. We may be good in terms of the amount of production, but if I look at the productivity levels, we are actually rice, wheat, wherever we talk of, we are actually 5th or 6th in terms of the productivity level.
Absolute number, but not per hectare, I guess.
Absolutely. Yeah. So I think unless the productivity level, including the productivity of capital, is taken care of in terms of, say, cost overruns and etc., we are not likely to see the per capita income actually growing to the extent we would like it to grow for a stability in terms of the consumption sort of in the system, and therefore fueling the private investments and etc. etc. Okay. So I think that's the way I will like to answer, but I don't think there's any easy solution for that. Skill development is one sort of perspective. And I think the other thing that the government possibly needs to solve is that we have talked about IIMs and IITs, the number of IIMs have grown, the number of IITs have grown. We have achieved good results in terms of the midday meal scheme and therefore full enrollment in the primary education. But the moment we move from the primary to the secondary, there's a huge dropout that happens, and the dropout rate in terms of the women is much higher. So I think these are some of the sort of micro issues that needs to be sorted for the macro results to emerge.
Right. So I have, I think, 2-3 minutes left. So I'll ask 2 more questions. Feel free to, jump in and answer. Number 1, what are the, probabilities of the tariff wars escalating into something which is let's say, a fundamental reset in geopolitical order, so which means greater uncertainty, and therefore it limits the abilities of businesses to really plan forward for the next 5-10 years, number 1. Number 2, if we were to enter a more turbulent, uncertain world, what happens to our Viksit Bharat ambition of creating, like Indranil said, move from a lower income to at least a middle income, and then hopefully sometime in a higher income bracket?
2 very quick observations since time is short. One is, I think India has demonstrated well its negotiating skills on the global map. As we've balanced the trading partners very well, who themselves, amongst themselves, are perhaps at loggerheads, we've been able to negotiate better. So I think that skill is going to be once again get tested, and in my full confidence, I would say that perhaps we are going to be better at negotiating with the US than other economies. 2, I would say opportunity in adversity. This is the best time for India to unleash all kinds of reforms. The chief economic advisor has been talking about deregulating, and manufacturing sector is getting shackled by it. So deregulation, the bureaucracy,
ease of doing business.
Absolutely. All of that needs to be tackled head on in not just incremental manner, but in a sweeping manner, I would say. And the third thing is taxation. I think both for the domestic players as well as the global players, it is imperative to have a very predictable, consistent, and relatively low taxation burden. And that is going to induce India's manufacturing sector to become long-term players. And I think once we have seized this opportunity and taken this adversity as creating those growth impulses, only then we can aspire for an 8% growth. Until then, we are on a maintenance GDP of 6.5. I would not say that is a extremely job-creating kind of a GDP.
Rajni?
Yeah, so Shubda has very beautifully captured what is required at this point in time. I will just add to that by saying that, it's very difficult to say what's going to happen on the global front. And this uncertainty and volatility is definitely there to stay. So the focus should be on ensuring that our domestic situation is in a good shape. Because we are a consumption-driven economy. 55% of our GDP comes from consumption. So if we ensure that the consumption grows in a sustainable way and picks up meaningfully, that will help. And for that, like you pointed out, the important point is real wages are not shown any growth. If you look at even pre-COVID, 6-7 years, real wage growth for salaried as well as casual laborer has been like flat or even negative. So it's important to focus on household income in terms of wage growth as well as creating more employment opportunities. Because we have this huge demographic dividend, which only we have at this point in time. Most of the developed economies are struggling with aging population, including China. And we have a huge market which the whole world is interested in. So we have to tap into that market. We have to create enough job opportunities. Like Indranil said, skill our manpower appropriately so that they are productively employed and ensure that our domestic demand is strong in midst of whatever is happening globally.
Right. Indranil, I'm going to let you have the final say.
No, so not to contradict any of my friends here, my only addition here is that I still am hopeful that Trump is using this as a negotiating tool. Now, unfortunately, Trump will not be unscathed.
To your point, actually, there's already talk of backpedaling on the Canadian and Mexican tariffs. So let's hope that happens.
Yeah. So if there is a tariff war, there is definitely a deadweight loss, and there are reams and reams of papers which show that the consumers are the ones who lose much more than the producers gaining. So Trump is talking about tariff wars, bringing back production capacities into the US, etc., etc. So somewhere there is a point, a cutoff point, beyond which Trump will also be pushed back very significantly from the Americans only. So how early that point reaches, and therefore there is a relatively more certainty. For example, in the last instance, he was raising tariff. I'm not really trying to paint a scenario like that, but COVID really put a stop to it. So here it will be more possibly macroeconomic implications of the tariff war that would enable US to, or lead US to show a much lower growth than what the American population will also desire. And that I think is, I'm still hopeful in terms of how the whole negotiation mechanism works out. And therefore the world would be relatively less scathed than what we are expecting today.
I hope so, because the evidence in terms of the academic research on tariffs is so conclusive that I'm surprised that this is even being considered seriously in the US, what the impact will be on the US economy itself and rest of the world. So let's hope that at the end of it, better senses prevail and we don't really go over the precipice and we are able to walk back from it. And the world can once again prosper and grow together as a globalized world should.